Greetings, and welcome back to the Rose Bros podcast. This episode, we're joined by Brian Boulanger, CEO of ARC Financial. ARC invests in early-stage, growth-focused oil and gas companies and in established, growth-focused energy transition companies with high-quality management teams. Since the launch of the first ARC Energy Fund in 1997, ARC has invested over $5 billion of capital in more than 180 companies. Brian joined ARC in 1997 and has overall responsibility for managing ARC Financial Corp, including the strategy and performance of the ARC Energy Funds and both investor and portfolio company relations. He is the chair of ARC's executive committee and is a member of ARC's investment committee. Brian holds a Bachelor of Commerce in Business Administration from the Ivey Business School at Western University, is a CFA Charterholder, and an Institute of Corporate Directors Certified Director. Among other things, we sat down and discussed making 12x returns for investors, choosing people over projects, and what to look for in an energy investment. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This podcast episode is sponsored by EcoFlex Recycled Rubber Solutions. EcoFlex has been providing the oil and gas industry with matting and safety walkways for 30 years, with mats that are resilient, flexible, and an eco-friendly option for your toughest site conditions. With shock absorption, insulation, and easy maintenance, EcoFlex mats are the perfect choice for any job. Check out ecoflex.com for more details. This podcast episode is brought to you by Canada Action, whose aim is to promote the importance of Canada's oil and natural gas sector. Energy and resources are the bedrock of our nation's economy and our day-to-day lives. Check out canadaaction.ca to order some free stickers and show your support. If you're ready, we can start.
Sure.
Good afternoon, Mr. Brian Boulanger.
Hey, Trevor.
Thank you very much for doing this.
Yeah, of course. Yeah.
I really appreciate your time. I know it's valuable, so thank you.
Of course. Yeah. I'm looking forward to the conversation.
For the listener, you are the CEO of ARC Financial.
I am. Yeah. I have the good fortune of being the fifth CEO of ARC. And the story I always tell is I spent my whole career at ARC. I was a summer student in the mid-90s. The fellow that hired me back then was a fellow named Lachlan Curry. He was a senior investment analyst, and I was a junior investment analyst. Anyway, Lachlan went on to become the fourth CEO. The first ever employee became the third CEO, and then before that was the two founders. So I tell that story only to give you a sense for how we build our organization. It's very much succession planning from within. So always trying to develop our younger people into more senior people.
What is ARC Financial?
Yeah, good place to start, actually. So ARC Financial it's a private equity firm focused exclusively on Canadian energy, for the most part Canadian energy, but it's actually Canada's largest energy-focused private equity firm. And it was founded back in the late 80s. And the founders at the time had the vision of, why are these great Canadian oil and gas companies having to fly to Toronto or New York to raise money? We should bring the money to Calgary, and they can just raise it from us locally. So that was the vision of the firm. And so, without really knowing it, they set out to become a private equity firm and raise the first private equity fund in the mid-90s. At the time, they were doing other things. They shut down those other things or sold off those other business lines. And today, we exclusively manage private equity capital. And a lot of that investment goes into either small oil and gas companies, or we create oil and gas companies literally from scratch, where we'll work with 4 to 5 smart people, give them some capital to get their business off the ground, and then go look to build a business, quite frankly.
Why energy investing? How did you get into the sector?
Not as a sophisticated answer as you probably were hoping for. I was in school in Ontario between my third and fourth year. I wanted to come back to Calgary for the summer to live with my parents in the basement. And I called a friend's dad, who at the time was a head of research at a local investment bank. And I asked him for a job, and he said, "We're not hiring, but there's this firm called ARC, and originally at the time it was called Power West, but ARC Financial, he said, why don't you give them a try? And so I tried and got hired and liked the summer job, and they made me a full-time job after. And so the rest is kind of history. So a little bit by luck, more wanting to be in Calgary. And at that time, it felt to me if you wanted to be in Calgary, you had to be in the energy business. So, but I kind of stumbled into it and have really enjoyed it.
Did you have any investing influences along the way? Maybe a Seth Klarman value style investing or a Phil Fisher growth style investing strategy or preference? How did you think of it that way?
Yeah, I'd say one of the investors that I've got to know over my career was David Swenson. And David was the CIO, passed away during, the last year or two, which is very unfortunate, but was the CIO of Yale Endowments and was there for 30 plus years and, takes a very much long-term approach to investing. He's very focused on people as well. And, consistency, looking for people that do what they say they're going to do. And so that's had an influence on my investment strategy. You'll see as we go through the conversation, it's very people-oriented.
I've said this before on the podcast, but I'll say it again, the least fragile people are the most likely to do stuff like this. So I don't know if you noticed that or you think about in terms of getting out in front of the public and talking about stuff like this. Is that something that goes through your mind?
Least fragile people do
willing to do stuff like this.
Like a interview podcast?
Yes.
Yeah, I don't know. I mean, you've done more podcasting than I have. I'm more a consumer than a avid participant, but I don't know. I mean, I think it goes with public speaking as well. I mean, to a certain extent, mileage matters. And if you get a chance early in your career to develop your public speaking skills, you take it on and you just get more comfortable with time. And so I really do think for public speaking, practice makes perfect. And, that's probably the same thing with respect to interviews.
It seems like there's a correlation between the best leaders and their willingness to get out and do stuff like this. So
yeah, I definitely think, a leadership trait, it doesn't have to be there, but it's helpful if you can represent your organization, represent the people you work with, be comfortable communicating what you do. I mean, a lot of what I have to do is meet and spend time with investors. So that does take a certain level of comfort in terms of, being able to tell your story.
When evaluating an energy company, what's the most important metrics that you lean towards? Is, for instance, in cash flow, reserves, is it management? What do you look for? Well,
and this comes back to what I said there at the beginning. In our line of work, it's people. Many of the businesses that we start, quite frankly, they just come from a PowerPoint presentation. They have no cash flow reserves. It's a group of individuals, even in some cases, a individual that wants to start a business, and we help them build their team. We then subsequently help them build their business plan, and then give them capital to go out and hunt for assets. And so we have a saying here at ARC, it's people over projects. We've made that mistake a few times where we've been enamored with a project and it maybe didn't have the best people, or we were worried the best people weren't there, and you can't overcome that. You might get lucky and overcome it, but odds are you're best to shy away from that. Then you're looking for, quite frankly, cost structures. If you're going to be in the energy business, you have to have a very competitive cost structure, because ultimately we're all just fighting for market share in the oil and gas game. And so if you can't reliably and competitively produce barrels or molecules of energy, you're not going to win. So combination of people and attractive cost structure.
Previous guests on the podcast have suggested the immediate return of cash flow is one of the most important things. How important to you is the sense of urgency in getting your money back tomorrow, aka a bird in the hand is worth two in the bush?
Yeah, that's kind of a new thing. I mean, that new being like post-COVID or something out of COVID. And it's an interesting way that the investment community has gone. Certainly the public markets and the public market investors are demanding that. And if corporations do much to push out their return of capital timeline, usually they are punished in the marketplace. I'd say that's a way to look at it, and it's a fine and smart way to look at it. It's just one strategy. I think it doesn't need to be so narrow. I mean, what we have in our setting, where we're investing in private companies that we own exclusively, we have the ability to reinvest that cash flow into growth. And if you've got highly profitable well economics, your model should tell you that you should be growing and taking advantage of that inventory and those economics. Now, would say one of the reasons people have prioritized return of capital is over my career, oil and gas companies have been terrible allocators of capital. And so they have prioritized growth, but they haven't necessarily prioritized profitable growth. And, price curves, et cetera, over time had a reason for people to do that. But historically, the return on capital employed in the oil and gas business has been terrible. So one very simple measure is to say, if you can't send me back more than I've given you in a pretty quick hurry, then I'm not trusting your capital allocation decisions.
Have you noticed a shift towards that mindset the last maybe 5-6 years in the industry?
100%. I mean, it's actually what I think makes the oil and gas industry more attractive today than it has been in a long time from an investment point of view, because globally, we are underinvesting in oil and gas. And there's lots of data to show that. As a result, you're seeing structurally higher commodity prices globally. And yeah, I mean, oil and gas companies were, they were sort of terrible at it. I mean, when oil and gas prices used to go up, they would just drill, bring on as many barrels as they possibly could. And of course, kill the golden goose. That would bring on too much production. Prices would collapse. People would retrench, some would go bankrupt, and then here we go again. Whereas in this case, the whole industry globally is behaving differently, which I think does set up a very interesting investment environment.
Is it different this time? Everyone says that there's discipline in the industry nowadays, but do you think that ultimately we'll revert back to greed, more or less? People start drilling and things will just collapse again, or is it different?
It's such a cliche thing to say is it's different this time. I mean, I fundamentally believe that's true. I think the biggest risk, I think that's true in a North American context, and I'll explain why in a second. I think the bigger risk on something like that is non-commercial actors like OPEC decides to just globally shock the world. And it could be arguably in their best interest, at times just to remind the world that they are in a sense, the marginal producer. So I think that's a risk that one needs to keep their eye on. And I can talk about how you would do that in terms of managing your own business through that. But I think within North America, one, investors are demanding it. Two, compensation structures have been reoriented to reward management teams that do it. Thirdly, quite frankly, it's easier. I've talked to some CEOs, and it's easier to run a business that's only reinvesting 70% of its cash flow versus 120%. You have to procure less equipment. You don't need to keep hiring people for growth, and you can pay yourself a dividend. And so it's also financially rewarding. And so I think for a bunch of reasons, I don't see that trend changing anytime soon.
What makes a good energy investment to you?
Well, you asked this question of me as we were kind of walking in here to the meeting, or you mentioned to me that you were going to ask that. And so the way I'm going to answer it pretty high level, but I think what makes a good energy investment is, firstly, I said management, but after that, it's a business that can deliver low cost, a relatively clean energy in a safe way and in a reliable way. I think those are sort of the basics. After that, you can drill down in all the different financial metrics. But if you can come across a strong management team that has a vision and a mindset and or an asset that has those four attributes, low cost, clean, safe, and reliable, I think it's something worth digging into.
In terms of the mechanics of the fund, oil and gas / energy is awesome on the way up, but oftentimes on the way down, it's terrible. Your job is to invest capital with the expectation of a return. How do you structure the fund so that when energy goes down, the investors are protected?
Yeah, so our investors are looking for exposure to energy as part of their portfolio, and many of them look at it from an inflation protection point of view. And so, they're wanting us to get them exposure. And so with that comes the fact that oil and gas prices may go up or they may go down. They're not necessarily, some are investing in us because they think oil prices are just simply going up. But a lot of them are just looking for that exposure as part of their asset allocation. And so you're right. We have to nobody knows the future. We have to build businesses that are resilient enough if in tougher times that they do okay. And, the simplest and easiest way to do that is through balance sheet. You just, in a commodity-based business where we've seen anything from $150 oil to negative whatever it was oil, how can you carry much debt in a business where your key lever is outside your control beyond maybe you can hedge for a couple of years? And so having very little debt is the best way to build a resilient business. After that, you can look at other things like decline rates, and ideally you've got some longevity to it. And as I said, low cost structure so that you can compete at the bottom. But really, it's the balance sheets. And, one thing that's interesting is no one ever models, like no CFO produces a model for their board of directors that says, hey, this is how we get into financial distress and go bankrupt. You just never see that presented. Yet companies end up going into financial distress all the time. And so I think, it's incumbent upon the best management teams and the best boards to encourage or almost insist that their finance teams or CEOs put forward that model so people can see how quickly you can get into distress. And that really needs to be sort of shared within the organization, because if you're not doing that, if every model the CFO puts out shows things are going well, there's instead they do like a base, low, high, but low is just making less money than base, that they need a really distressed case, because otherwise the technical people go out and just do their jobs. They just assume if I execute from a technical point of view, we will be okay. And so they have to kind of tie it all together to show how quickly businesses can get into distress.
One of the key elements of a good return on your capital is time. Zombie companies. When a company's been around for too long, how do you make sure that the capital is safe? Or are there clues that you look towards when things have gone too long? Or how do you protect against that scenario? Sometimes it seems like companies just go on forever. Yeah.
That's on the board. The board controls that decision. Effectively the board approves every budget, and every acquisition. And so if a company's not doing well, it's on the board. And it would be incumbent upon them to either make a change of the leadership team and or look to merge the business out. So, sometimes it's amazing to me when you see situations where boards will complete an acquisition, boards and management teams will complete an acquisition. 2 years later, that acquisition is determined to be a bad acquisition, and they just simply want to blame management. I mean, the reality is the approval of that decision was by the board. So the board has to really assume that responsibility. So that's incumbent upon the board to move things along when they aren't happening in the right way.
Is it a strict timeline that dictates that decision? Or are there clues that you get that things are going too long and that things aren't going to turn around? Or are there things you look towards?
I think, there's not like a simple rule of thumb. I wish investing was that easy that, within 3 years, you'll know. I don't think it's that simple. I think, we have a process over here at ARC where 2 times per year we have our management teams and companies come in and present to the broader partnership. And the name of the meeting is results versus plan. And so literally looking back on your results versus your plan with a lot of rigor, I think is one way to tell. I mean, the other way to look at a business is just these can be sort of simple questions you can ask yourself. Is it on track? Is it looking like it's heading the right direction financially? And is it on strategy? Because that's where a lot of companies can get into trouble. If, the strategy at the beginning was to go and develop light oil, and next thing you know, they're exploring for natural gas or something like that. You really got to ask yourself, well, how did that strategy drift happen? Was it intentional? Did you do it for all the right reasons? Because usually companies that get off strategy can get off track pretty quickly too. So those are things to be mindful of.
Does ARC take a portfolio approach to its investing, or do you concentrate pretty heavily? Is that a big element of the, whole picture is kind of dealing with the losers and the winners, or are you very concentrated?
We're concentrated and increasingly concentrated. And actually this is something that I learned from David Swenson as well, is diversification in oil and gas to a certain extent is false diversification. Because if WTI is going the wrong way, the fact that you have 20 oil and gas companies versus 5 oil and gas companies is probably not going to help you. I mean, there's some sort of minimum diversification you want just in terms of getting people and play types and that, but we'd much rather have a smaller portfolio that we can stay close to than try to spread the risk away.
The best investors think like business owners and vice versa. By definition, you need to be different to succeed in business. A lot of the best entrepreneurs and business leaders are different to achieve success. When you're hiring people at ARC, how do you ensure you're not just hiring people who are good at writing tests, that people who think outside the box and are creative and maybe entrepreneurial thinking to oversee the portfolio?
Yeah, now you're talking about diversification in a different way, and it's on the team. And the way we think about it at ARC, one, we are intentional about it. We measure. I have a saying, well, not my saying, but there is a saying, what gets measured gets done. And so if you're trying to track it, you can kind of look at the results and say, okay, how are we doing? Because if you're not intentional about it, it can just kind of get away on you. But we think about diversification. I mean, of course, there's gender diversification, which is important to us, but as well, young versus old, creative versus analytical, risk seeking versus risk adverse, technical versus financial. We try to weave there's others, but we try to weave all those things together and to say, are we building a diverse organization and a diverse set of people? Because I think ultimately it allows you to make better decisions. At times it can slow you down because you're really trying to satisfy a diverse group of people. There are times when we'll sit around our boardroom table and, disagree. And at times that can lead to frustration, but then you have to remind yourself, this is why we have a diverse organization, because we're trying just to get to a better decision. And it may take more time and it may take some disagreement along the way, but ultimately that should be a better ultimate decision. So yeah, you have to be intentional about it.
How do you detect that kind of unconventional thinking, or is there clues that point towards that in a hire or people that you're overseeing, or are there ways you look towards that?
Yeah, I'd say, well, of course, you can try to figure it out when you're hiring. I mean, when we hire, it's no different than when we invest. We do endless amounts of reference checks on the person. Like, people are generally predictable. If I call 10 people and ask about you, Trevor, and 10 people say you're very hardworking, it's unlikely if I hire you the next day, you're going to just start slacking off, right? And so people are predictable. So references, and particularly non-provided references from people that weren't on the list, if you can get those, you can usually try to figure somebody out. And then it's how do you pair people up once you're on the team together? We also have another saying here at ARC that nobody should work alone. It's kind of two people on every project, whatever that might be, or every file. And you try to pair people up that are not the same. Ideally, there's some differences there. And then the other thing, we on a fairly regular basis here at ARC do 360s. And so you kind of try to, from that you can garner different people's behavior and different person's thought patterns. And so you can just try to have a lot of self-awareness, I guess, is what I say. And we encourage people to share their 360s with others. So not only are you relatively self-aware of your own strengths and weaknesses, but the people around you also understand your strengths and weaknesses too.
In the beginning, ARC was a small entrepreneurial organization, but it's grown. The book is huge now. The best business leaders usually have skin in the game with their own money up front. How do you incentivize people and make sure that everyone's properly incentivized? Do you make people invest their own money into the funds? How do you do that?
Yeah, good question. And this comes right back to the early days of ARC. Virtually everybody at ARC, and this would be a little bit unusual, just about everybody at ARC, right down to our latest analyst hire, will have ownership in the funds. They'll have both management fee ownership and carried upside interest. And in exchange for that, they're expected to invest. And so, that's how you get everyone aligned, pulling in the same direction. And it's a great thing about working at a private equity firm, because you just truly have that alignment with your partners. And to have financial success and rewards at a private equity firm, the whole fund has to do well. It can't just be a single investment. The fund has to perform for the investors, and then you as the GP are financially rewarded. So as a result, it's not like a company is somebody's file and, I wish them luck on it. If a company's struggling, you got the whole weight of the firm behind it. If a company's doing well and it needs additional horsepower, you have the whole weight of the firm behind it, because we are all aligned to ensure it's the fund, it's the whole business is successful, not just any one deal.
When you're investing, how important is that for the leader of the company that you're investing in to have their own money and not just have the options given to them? Do you expect the leader of the company you invest in to put their own money up, maybe a second mortgage or something along those lines?
I'd say, yeah, 100%. I mean, if they're not going to put money into their own business, why would we? It would just be weird. We would just move on. What we like to see is that the senior management team have what we call, quote unquote, a meaningful amount of capital invested. And that can mean different things for different people at different stages of their life. We don't expect everyone to go put on a second mortgage bet at all. I think that can lead to other unintended consequences. Like, you might find you create somebody that you almost incentivize somebody to become so risk averse they can't do anything if there's that much downside to them. So, but we just look for a meaningful amount. We have a conversation with them, probably often more just holistically what that looks like. You kind of have a sense for what somebody at their stage of career should be able to invest. And, at other times we want to make sure that it's basically their only oil and gas holding too, right? I mean, we don't look for people to sort of take their energy exposure and spread it out to 10 different companies, one of which is theirs. I'd prefer that it's their energy exposure because that's how it works for me. I mean, us and our partners at ARC, our only energy exposure is ARC Financial and the portfolio companies which we own.
Return on capital versus return of capital. What is the difference, and how do you ensure that you're getting a return on capital instead of just return of capital?
Yeah. So I'd say, well, first of all, it should just come on the financial results over time. I mean, that's one of the complicated things about the oil and gas business is the cycle time is so long. I always jokingly say if Trevor, you and I owned a pizza shop, we would know each day at the end of the day whether we made money or not. And if we weren't making money, we would either put less pepperoni on the pizza or we charge more for the pizza. The oil and gas business is much more difficult and people can get confused. There was a very well-known businessman here in town, very successful oil and gas individual who was in a board meeting one time and I have this story secondhand, but was in a board meeting one time and the CEO was going on about all the new reserves they had found that year. And his quote was, well, that's good, but if we find any more reserves, we might go broke. And you have to look at it more comprehensively. I mean, two things that I like to look at is production per share growth, debt adjusted. That usually is a more real-time measure, and you have to make sure you do the debt adjustment. And then, quite frankly, recycle ratio is a really healthy one. And that's sort of what that CEO's or that board member was joking about. When if we find any more reserves, we're going to go broke. Because you have to convert reserves into cash flow and you have to do it profitably. And so recycle ratio is a good measure for that.
One of the analogies that people on the podcast have used are widgets in the warehouse, and that you don't need that many widgets or you don't need exponential widgets to make it a profitable oil and gas business. Do you think of it that way? Or is there a tension between building up the warehouse full of widgets, so to speak, and earning cash flow today for investors?
Yeah, for sure. And that's why the investors have said, just show me the money, pay me a dividend, and I'll decide if it's healthy enough and you can maintain your business while paying me a dividend. Because that's a very simple measure, right? Am I getting a healthy yield, and are you able to maintain the business while paying me that yield? I think for sure. I mean, I think one of the challenges in the oil and gas business, particularly the junior oil and gas business, is you can find a lot of management teams and quite frankly boards that they get mistaken. It's like they think they're in the molecule creation business. They're not running a small entrepreneurial business, which is what they are. And so they can get just lost in either the sort of the technical aspects or the wrong aspects of are you making money or not? Because that's really what you are. You're running a small business. You're not running a molecule creation business.
Past guests have said that that's one of the best things about Tourmaline and Mike Rose is that he's able to balance the capital allocation with the best geology in the business. And that's what makes the A-list of energy companies. Yeah.
I mean, you're highlighting one of the best, if not the best of all time. So there's a guy that can do it all and lead a very successful organization. So Mike's done an incredible job.
Cost of capital. Sometimes when you ask people in the industry what their cost of capital is, they don't know, or they'll say 10%. It's kind of murky. How do you think of that with ARC's portfolio? Do you have a base you go off of? You think about your investments? How do you approach it?
Well, I mean, quite frankly, in the private equity arena, you are looking for outrageous rates of return. That's what our investors are expecting. I mean, they're expecting an associated level of risk with that, but ultimately they want to see funds that can deliver a 2x multiple in 5 to 7 years. And so that implies at least a 15% cost of capital, if not higher. When we're underwriting transactions, we're looking for things that can exactly that double in 4 to 5 years. I wish it was that easy because saying an archery or whatever, you have to aim a little high to hit the bullseye. So you have to, your model has to at least have something like that in it. I think the 10% just comes from what return might I need just to tread water? And I'd say for a private equity firm, that's usually somewhere between 5 and 10%. And, in that case, your investors they're sort of looking at that like, I've given you my money, you've kind of treaded water on it, and now you've given it back to me. So it's got to at least reach that.
Did you remember one that really seemed to hit it out of the park in terms of investment success?
Oh, yeah. Yeah. Well, we just had a recent all-time winner here at ARC, which is a company called Delta Stream. We had the good fortune to be around the group when it was founded. and we were their largest shareholder, and actually took out the other shareholder partway through. So we, near the end, were effectively us in management, and they did a wonderful job. It was a 12 times multiple. So incredible success story. They did a great job of getting into a play called the Clearwater early. Arguably, some would say it's the most profitable play in North America, and it was a great result for us.
During the worst times of energy, maybe the spring of 2020 when oil went to negative or to zero, what were you thinking then? Were you sensing opportunity, or was there a lot of stress? What were the thoughts going through your mind at that time?
Yeah, for sure. There was stress. Yeah, no doubt. Yeah. You know, when your sole investment strategy is junior oil and gas companies and oil goes to zero, you've got a lot of problems on your hands. I mean, it's easy to look back on it now and to say, oh boy, it wasn't that obvious. You should have just bought everything. The problem was, if you intellectually, honestly look back at that time, you know, nobody had any idea how long COVID was going to persist, how long demand for oil and gas barrels was going to be down and out. And so our approach at that time was to not toggle risk, but to try to keep risk consistent and look for businesses that we felt could survive. And so, yes, there were some very highly levered names that you could have bought at the bottom that if COVID lasted a couple extra years, you would have lost all your capital. But because it didn't, it was an incredible rate of return. We looked for those businesses that at a $50 recovery price, and if COVID were to last an extended period of time, would survive and get you to the other side. And so we knew the upside would take care of itself, but that we looked to toggle risk, not necessarily just seek the best rates of return. Because we do manage capital on behalf of pensions and endowments and foundations. And, you know, if you think about an endowment or you think about a pension, you know, rule number one is do not destroy capital. And so we were very focused on any capital that went in at the bottom had to at least come back to us, even if COVID lasted for a longer period of time.
The debate now is dividends versus buybacks. Do you have a preference, or does it depend?
I don't have a strong preference on that. I think probably a blend of both. Yeah. We don't have a lot of public holdings, so we don't spend a lot of time thinking about that, quite frankly.
Are there questions you ask certain companies to see if they're thinking about cost capital correctly? Are there ways you approach it, or are there strategies or certain questions at the end of the day that you have for management teams to make sure they're thinking about ARC's money correctly? Yeah,
I mean, we just look for it in what sort of analysis they're putting forward around an opportunity. We've had situations where if the team has come over here interested in completing an acquisition, and the presentation is so technically oriented, it's like they haven't got around to trying to figure out how they're going to make money off it. It's all about inventory, or it's all about drilling locations, or all about a certain, you know, play type. And so it's really got to shake out in how are they able to present to you the financial returns in addition to the technical merits of a transaction. And, you know, where we've struggled with that in the past is we've just looked to bolster the team and bring in that type of person. And so, you know, like we ask the question, who at this company is going to stay up at night wondering whether I'm turning one of ARC's dollars from 1 to 2? And that has to be somebody's job on the team. And I can tell you, not all, I mean, it's better now than it once was. There are small entrepreneurial oil and gas teams that I'm not sure that they have that on their roster.
Mm-hmm. Have you noticed a shift in the industry towards the importance of capital allocation versus the capital exploration over the years?
Yeah. I mean, cost of capital for oil and gas has gone up. I mean, there's fewer oil and gas investors today than there were in the past. And so those that remain are pretty technical and pretty savvy and understand pretty smart capital allocators. And so when the scarcity of capital does sharpen the pencil when it comes to allocating capital, whether that be for a private equity firm like ourselves or a management team, you just have to be bringing forward high quality projects in order to access capital today. So yes, there's less capital in the system now, which is, I think, resulting into a more disciplined space.
On the flip side, there's not too many energy funds left. There's maybe 2, 3, or 4 left in Canada or the US. Has that created opportunities for you? Has it made life easier in a way?
Yeah, for sure. It used to be, when I started my career, we were kind of the first private equity firm in Canada. we were focused on energy for the most part. Our competition at that time was the public markets, because CEOs had a choice of whether working with a private capital provider like ARC, which would provide you with long-term consistent capital, but we do ask our questions and do want to be involved, or they could have jumped on a plane, flew to Toronto and raised some pretty quick, fast money, but that money was not necessarily going to be consistent. But if they were willing to go public, they could probably get up and running even more quickly. I'd say over my career, I think a lot of entrepreneurs have realized the benefits of having long-term, consistent private capital or capital sponsorship, because you want that. It's easy to get capital in good times. It's harder to get capital in the tougher times. And if you've got that long-term, consistent private capital supporter, they should be able to support you in the tougher times as well. But now when you look today, there's just less competition. Absolutely. That makes our spot in the marketplace even more advantaged.
Energy's down the last year or so. Why is energy down? Do you have a reason that you point towards, or is it just the nature of cyclicality of the business?
I think probably the most obvious answer is inflation. I mean, I think we had gone through a period there when it's called like the 52-week highs in the last year. That might have been peak margin, because you had a period where commodity prices were pretty strong. And I think service costs and just global inflation pressures on things like steel hadn't really been pushed through. So you had this, the service companies were sort of the last to sort of reestablish their margin. And so if you look at what's happened with the oil and gas companies' cost structure over the last year, it's up and commodities are down. So margins are just smaller than they were at that 52-week high period. And, you still see quite a bit of volatility in the commodity prices, both in natural gas and in oil. So I think it's that on top of it probably has depressed some investor interest.
What worries you about energy these days? What keeps you up at night?
I'd say what worries me is, to a certain extent, policymaker and society's lack of understanding of the importance of energy globally. And we saw what happened in Europe, the disruptions over there. And I think countries in Germany and other places had, they got a little bit lucky in terms of what it could have been. Had it have been an awfully cold winter, you would have seen, some probably very real financial strain put on certain households and pockets of the world. And as well, I mean, if it could have got so bad that you could have seen actually like some real human tolls. And so, energy is a vital commodity. And I'm not advocating for just oil and gas in that. I'm talking about all forms of energy. And so the world really does need clean, safe, reliable, but ideally affordable energy. And so that lack of understanding in terms of policymakers and societies maybe broad awareness of it, does worry me.
A policymaker who's listening to this podcast, what advice might you give them? Do you just want clear rules, or what would you suggest is the best way forward when you're thinking about Canadian energy policy?
Yeah, I think it's clear rules for sure, and consistency and duration to those rules, but then, a way to embrace what are Canada's various clean sources of energy, both within oil and gas and in renewables. And so, Canada really can be a provider at a global scale in terms of the world's energy needs. And, we should be celebrating that, continuing to encourage people to reduce emissions and in a cost competitive way, and continuing for us to keep producing the clean barrels. I mean, arguably, when you think about it in a holistic sense, one day in the future, when we consume our last barrel of oil as a globe, that should be the very best barrel. Shutting down really good, clean Canadian energy, it's not going to reduce demand. It's just going to mean that demand is filled by somebody else, and it may not be as clean, or it may not be as safe, or it may not have all the important ESG profiles.
Today is June 12th, 2023. If you were to leave the listener with advice on energy investing, what might you suggest?
Oh, now is a great time. I really do. I think it is. I mean, valuations are so low. You have to take a long-term approach because it will be choppy. But now is a great time to, I think, get positioned in energy. And when I say energy, oil and gas, I also think it's just deep value. It looks like deep value, and it does look like structurally commodity prices are going to be more consistent, and it does look like profitability is pretty attractive. I'd say on the flip side, I really do believe in energy transition and renewables as well. It's clear that that's where the world's going. The spend in that, if oil and gas spend is measured in the $500 billion range, energy transition global spending should be measured in the multi-trillion dollar range. And it's not a fad. You and I won't be sitting around in 3 years and say, oh, remember energy transition. It's here to stay. And so that's a high growth area. And it's also, I think, smart to get exposed there. But because it's high growth, it's more expensive. And it's in some ways nascent. So depending on how you approach it, there can be more risk, say, than an oil and gas investment.
Well, I think that covers the waterfront. I really appreciate your time today. Also, a quick shout out to Cody Battershill for connecting us.
Yeah. And thanks to Cody for all he does on behalf of the oil and gas business.
And that's it. So thank you. We can wrap it up there.
Thanks very much. Appreciate it, Trevor.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.